The S&P 500 is sitting at an all-time high right now, but if you look just beneath that flashy headline, there is a glaring structural divergence going on. We are looking at a historic concentration risk, where a handful of AI-leveraged firms are essentially masking stagnation across the rest of the global economy. This isn't just another tech rally. It's a fundamental bifurcation in how the market values the future of productivity. Capital is effectively drawing a line in the sand between the architects of this new infrastructure and, well, everyone else.
When the index closed at a staggering 7,398 today, it projected this image of a broad economic victory. But actually, scratch that. Look at the internals. The majority of the stocks within the index actually lost ground. We are watching a ruthless, real-time reallocation of capital. Institutional money is flowing rapidly out of companies that lack a clear path to AI integration, and it's funneling directly into the select few that control the architecture. The psychology here is purely defensive. Asset managers are realizing that holding legacy businesses with static margins is incredibly risky when the foundational cost of intelligence is completely collapsing for their competitors.
You can see this friction perfectly with the Dow. On a day of historic highs for the broader market, the Dow barely even moved, posting a gain of just 10 points. This divergence between growth-oriented tech and traditional industry is the defining reality of this market cycle. You're either part of the AI value chain or you're facing stagnation. The broader industrials are being treated almost as bond proxies right now, safe, slow, and entirely disconnected from the compounding growth happening inside the tech sector.
Historically, energy shocks of this magnitude, with Brent crude well above $100 a barrel, alongside sustained geopolitical friction in the Middle East, would heavily pressure equities. Yet the market is just absorbing it. The institutional belief right now is that the sheer efficiency gains unlocked by AI will simply outpace and offset rising input costs and higher for longer interest rates. We're seeing a market pricing in a deflationary technology boom so powerful that it essentially overrides traditional macroeconomic headwinds. Investors are betting that algorithms will solve margin compression faster than inflation can create it.
Because we've officially crossed a critical threshold in this cycle. The era of a CEO simply mentioning artificial intelligence on a quarterly earnings call to get an immediate stock bump, that's over. The monetization phase has arrived. We are no longer pricing in future potential. Markets are pricing in actual accelerating revenue that is happening right now. The companies being rewarded are the ones moving from abstract research papers to deployed enterprise software with a measurable immediate impact on the bottom line.
And at the corporate level, the incentives driving this shift are undeniable. Alphabet's AI products are up nearly 800% year over year. But the real structural driver is enterprise adoption. Models like GPT 5.4 are now actively matching the output of human professionals. They are effectively saving over 4.5 hours of a standard workday. When a technology gives a company half of its workforce's time back, the incentive to adopt isn't just strong, it's absolute. The efficiency gains are simply too large for any board of directors to ignore without risking total obsolescence.
To actually support that level of enterprise adoption, capital expenditure is scaling in a way that defies traditional tech cycles. Big tech has committed $650 billion in CapEx for 2026 alone. This isn't just software procurement. We are talking about a physical construction boom to build localized, high-throughput AI data centers globally. And crucially, Wall Street isn't punishing this massive spending. Historically, markets penalize massive capital outlays, but right now they're demanding it. They view this expenditure as a necessary mandate for future survival, treating it more like national defense spending than corporate R&D.
We have truly graduated from the AI hype cycle to the AI industrial cycle. Efficiency is the new energy, and silicon is the new oil. Think about that for a second. This is no longer just a software trend. It is the rapid industrialization of intelligence. The physical infrastructure required to sustain this shift is completely reshaping global supply chains, and it's demanding raw materials at a pace we haven't seen since the very early days of the internet build-out.
This industrialization creates a massive second-order effect, which is a heavy asset rotation. While retail attention has been hyper-fixated on the familiar chip makers and consumer software interfaces, smart capital is quietly moving toward the physical infrastructure. The concept of the cloud is just a metaphor, right? AI actually lives in steel, concrete, and copper. And the companies that extract, process, and assemble those raw materials are suddenly finding themselves right at the epicenter of a historic technological build-out.
The physical bottleneck of this new economy is power. A single AI data query requires 10 times the electricity of a traditional baseline search.
The primary constraint on AI development is no longer software engineering, it is grid capacity. This massive, relentless energy draw is forcing an aggressive rotation of capital into utility companies, the power grid, and industrial firms that can actually build the physical backbone to keep these models running. We're watching tech investors suddenly having to model out nuclear power timelines and natural gas pipelines just to understand the growth trajectory of their own software portfolios.
We saw the ultimate reflection of this infrastructure demand recently with what I'm calling the SanDisk anomaly. A legacy memory firm spun off and then surged 3,300%. The reason is incredibly pragmatic. Frontier models are functionally useless without high-speed storage. They can't process or think without moving massive amounts of data instantly. The gold rush expanded from pure processing power to memory storage almost overnight, simply because hyperscalers realized that computation is totally bottlenecked without the physical architecture to hold the data.
So this legacy hardware company is now seeing unheard of 100% incremental gross margins. Basically, almost every new dollar of revenue is dropping straight to the bottom line as pure profit. When physical storage manufacturers start trading with the unit economics of a nimble, high-growth software startup, it confirms the infrastructure phase of this supercycle is fully underway. It signals a rare moment where physical constraints allow hardware manufacturers to command the kind of pricing power that's usually reserved for monopoly software platforms.
But for every massive gain, there's a corresponding penalty. We are seeing a severe valuation reset for traditional networking and hardware firms. Companies that rely on older architectural models and lack a clear path to AI leverage are being aggressively repriced. They simply can't maintain their historic profit margins as the industry shifts toward custom silicon and direct-to-hyperscaler models, where massive data center operators just bypass the traditional middlemen to design and source their own components. If you're a hardware vendor standing between an AI builder and their silicon, your margins are being completely eroded.
Looking a little further ahead, the market is already bracing for the mid-2026 SpaceX and xAI merger IPO, which carries a proposed valuation of $1.25 trillion. $1.25 trillion. We're looking at a vertically integrated entity that controls everything from orbital satellite infrastructure down to the frontier reasoning models running on your consumer devices. This represents an absolutely unprecedented concentration of physical distribution and digital intelligence under a single corporate umbrella. It's setting a totally new benchmark for what scale actually means in modern markets.
The strategic implication of a $1.25 trillion mega entity entering the public markets is profound. It's going to act as the ultimate innovation drain. This structural shift creates a massive liquidity vacuum, rapidly draining capital away from other sectors as institutional investors clamor for exposure to a unified, physical-to-digital AI ecosystem. When that much passive and active capital is forced to allocate toward a single, unavoidable behemoth, it starves mid-cap tech and legacy industries of the investment dollars they desperately need just to compete.
As capital drains from those traditional sectors, those industries are being forced to integrate AI just to survive their own structural crises. Take the pharmaceutical industry, for example. They're staring down a $230 billion patent cliff by 2030, where their most profitable drugs lose exclusivity. Their solution isn't to hire more human researchers, it's deploying OpenAI's GPT-Rosalind, a life sciences model designed to autonomously run complex protein folding, simulate clinical trials, and fundamentally alter the unit economics of medical research. They are essentially outsourcing scientific discovery to algorithms to replace the revenue they're about to lose.
All of this forces us to fundamentally reevaluate the very nature of the assets we hold. Are we simply investing in software, or are we finally investing in the cure for time itself? The market is recalibrating human productivity on a foundational level. I want to know how you are positioning your own portfolios for this rotation into heavy assets. Leave your specific thesis in the comments below, and let's discuss what the market might be mispricing next.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.